All right. Welcome, everyone, to this week's Sunday macro wrap up for Sunday, August 3rd, the first Sunday macro wrap up of the month of August 2025 here. Lots to talk about from what happened last week. As we know, we had a pretty decent dip in the market on accelerating volume. Taking a look at the SPY, the S&P 500 ETF here. And so, yeah, the way that we want to pay attention to market moves is what happens in the context of accelerating or, decelerating volume as well as volatility. And so, yeah, I mean, what we saw was a spike in volatility here. And then also as well, if we're taking a look at historical volatility, it did spike a little bit, but not as much as I would have thought. This has been pretty much a low volatility period ever since really the mid-June. So I'm surprised it honestly took this long for us to have a little bit of a pop here. The big question on everyone's mind is this finally going to be a new period of bearishness? Is this the end of the big run? It's impossible to answer those questions accurately because they'd be guessing because we can't tell what the future is. But from what our signal says, even though this was a sell-off on accelerating volume, the bullish trend is still intact. So if you are in our macro investing community, you know that over the past couple of weeks, we've been talking about raising cash, and that's to take advantage of opportunities like this one that we just saw. And so if you guys are in our communities, you see that, we've been talking about different assets that are positively correlated to the S&P 500 that were also at their low end of the trading ranges. And so that's what we were taking action on, really. And so for those people who were following a process, raising cash and able to have some dry powder in order to buy dips, Friday was actually a good day because we finally got that discount there. But that, along with the dollar having a large deceleration as well, that was a pretty big move on Friday from the jobs print, which we'll go over all that data here in a second. But you had just a bearish day, right? You had bond yields down, spike in volatility, dollar down, just a little bit of a freak out there. And taking a look at volatility, we've been talking about the VIX below 15 here. And, we were using the analogy of holding a beach ball underwater, right? Because, it's just historically not that often where you have just sustained volatility below those levels. And so it wasn't surprising that we finally had a pop in volatility. So all those things are good, if you're following the process there, and that's what we want to try and do. We'll get into some other ideas closer towards the end of this 1 hour session. The way that these Sunday macro wrap-ups work for those who are new is that it's a 1 hour long session. The first 30 minutes is streamed online on our socials, and then the second 30 minutes is offline only for our macro optics members, where we're going to be talking about all this data and how to use those with actionable ideas. If you'd like to take part in that discussion, you guys can go to our website and check out our 7-day free trial and join in on the discussion. All right, so with that being said, let's go ahead and get into the data here. Last week was a pretty large data dump week. We had the typical first week of the month jobs dump, right? So typically the first week of every single month is where you get a lot of jobs data. So we had that, as well as the Q2 first quarterly GDP estimate. We also had manufacturing PMIs, core PCE, which is the Fed's preferred inflation gauge, as well as an FOMC press conference. So there's just a lot of things happening at one time, an atypically busy macro event week. And to chase that this next week coming up, it is pretty much radio silence in terms of the amount of data compared to last week, right? So the only thing really of large impact um, in terms of what we're expecting is the ISM services PMI, which has been having rebounds in other more forward-looking measurements. So we could see a rebound there, which would be good news, right? But we'll see what happens there as we get into the rest of the week. We are going to get some announcements on tariffs as well from President Trump. So expect this to unfortunately be a little bit of a headline-driven type of week here. Not that our process is driven by headlines, but a lot of the narratives you'll see this week are probably going to be coming from that. So not to stress yourself out too much from the talking heads on CNBC and a lot of those entertainment networks, just entertainment networks. They're not truly doing too much of groundbreaking analysis there, but they're great for entertainment. Anyways, let's go ahead and get into the data here. All right, so the first thing that we had was the job openings and layover turnover survey, right, JOLTS. And the big takeaway there was that we saw a pretty large deceleration in hires, right? So whenever the JOLTS numbers come out, the thing that I tend to look for is what's going on in the private market, right? So really what you get on TV is the headline number, which is fine, but the only problem is that it also includes government jobs, and that doesn't really give you a great indication of like the overall economy, which is why the team and I only focus on private job growth, because that's 90% of the market, 80% of the jobs market is private. So pretty large 2-month deceleration there in hiring. Let's take a look at layoffs. So layoffs have been trending upwards since it bottomed in October of 2021, but really you haven't seen too much of a spike in layoffs, surprisingly, right? And so when you take a look at this historically, right, it was 1,543 recorded layoffs in June, and that's pretty much been pretty consistent even before that in 2019 and 2017 pre-pandemic, right? So going all the way back to 2017, which was a pretty good year for a lot of people, that was around 1672. So really we're not seeing a spike in layoffs. And you'll see towards the end of this, I'll just do a spoiler. What I'm looking at after going through all the data today is that I think the sell-off would be short-lived, because really what the Fed is focused on is inflation. And even though you had a large misprint in terms of jobs accelerating, right, with the large number of revisions, which again we'll go over in a second here, I don't think it's enough to spook the market enough to cause rate cuts in September, which I know is a little bit of a controversial take there, but you'll see what I mean once we go through everything. All right, let's keep rolling here. We also got consumer confidence from the conference board, and that improved a little bit, but when you look at the entire index over time, I mean, it's still remaining at pretty much lower levels. As you can see from 2016 to basically the pandemic, you had it above 120. So there was a lot of optimism, those 4 years. And then pretty much post pandemic, it's been on a downtrend, a little bit of a spike in 2021, but since then it's been on a downtrend there. So confidence hasn't improved too much there. Taking a look at the private payrolls, right? So this is the ADP measure. So this is what we got on Wednesday. This is a different measurement of private job growth. But as you can see, job growth has been slowing down, especially the past couple months here. So there's definitely been a slowdown. After that, we got the GDP number for the first estimate for Q2, and that came in at 3.0%, 0%. All right, right. Huge rebound in GDP. The only problem is that it was really distorted by the imports section, right? So when you look at the formula for GDP, imports is subtracted. And so that's why this large acceleration caused an artificial bump in imports or in the headline GDP number. But if you take a look and just take a look at what really contributes to actual consumption, which is services, this alone accounts for 50% of the entire GDP number. As you can see, I mean, the 2 quarters in 2025 have been pretty low compared to the average from going all the way back to Q1 of 2023 until now. You can see that this is a huge drop off compared to the last couple of years. And so, with services making up over 50% of the entire GDP number, this is significant. And then the other ones I like to look at are durable goods, which has had a little bit of a rebound, but still pretty low. And then equipment investment has also normalized a bit here. So we did see that. What was interesting as well is when you take a look at the percent change from the previous period by sector for what was contributed to GDP, we can take a look at non-farm business, households, as well as the government. And as you can see, government spending or government consumption has declined a lot. Not spending, not going into debt. That has continued to accelerate. This is actual contributions from from the government, right? So that has been declining. But when you take a look at businesses and households, specifically with households, right, with consumption, you can see a general downtrend here, more weakness. And then when you dive directly into the services component or the consumption component by a month, year over year change in monthly data, you can see from going back to December of 2024 until now, you've had a fairly aggressive drop off in services. So just nailing that down as a different trend from what we've seen over the past couple of years is that huge downtrend in services there. That's a better, there's a better visual of the downtrend in services. All right, then we had the Fed meeting on Wednesday afternoon. Now the differences with the FOMC statement that they put out at 2 p.m., right? So the press conference is always at 2:30, the statement's at 2, and the difference between the June and July one was pretty significant. One was that they described economic activity as expanding at a solid pace in the June one, but at this one they said that it moderated somewhat, which is a nod to GDP or growth slowing. They also said that the labor market remains strong in both, so there wasn't really an acknowledgement of labor market stress. And then in this one with the inflation outlook, they said that inflation remains elevated. So it's more of a acknowledgement of growth slowing and inflation remaining much higher than what they anticipate. And really, when you take a look at the FOMC press conference, which we did a live for, if you guys want to watch that hour-and-a-half long live stream, it's on our YouTube page. But he was just focused on inflation the whole time. Really didn't give too much, diving into the labor market as well as growth. He calls those things normalizing, and he basically said we're focused on inflation and it's because of tariffs. So finger pointing at the administration there. All right, now let's get into the employment situation summary. For those who don't know, whenever they do the employment jobs numbers once a month, there's two different surveys. There's the household survey, and then there's also the establishment survey. So the establishment survey, you can think of them getting hard data from actual companies reporting about their hiring, as well as layoffs and all that stuff. And then the household survey is them just, calling people on the phone and asking households like, hey, are you looking for a job? Do you have a job? What's going on there? And so when taking a look at the establishment survey, right, so businesses reporting, this is where we got the headline number, which is where you saw those two downwardly revised numbers from May and June, which caught the market by surprise here. And then there was also just a very weak acceleration in July. If you take a look at the jobs revisions on a monthly time frame going all the way back the previous 24 months, over the past 2 years, 16 out of the past 24 months have been negatively revised jobs numbers. And so, even from 2023 to 2024, you've had the majority of it be negative revisions. So the market, has been used to and continued to make all-time highs while we've had negative revisions. But the reason why they're carrying now is because one, it wasn't pricing in the magnitude of the negative revisions here, right? Negative 120, negative 133. These are large negative revisions compared to the average from the past 2 years. And so that just caught the market off guard. And so what's interesting is that when you take a look at the initial reading, which is in blue here, versus the actual reality by the time they do a third revision, you can see, pretty much from January of this year, look at the gap between what was initially reported versus reality. I mean, how do you miss that much? Even before then, I mean, you kind of had it tighter, right, in terms of the initial reading versus before, but you really see a huge widening here. So I'm not sure what that's all about, but just looking at the numbers, that's what is showing that there. All right, and then moving on to, actually, let me just show this last graph here. So this shows the jobs growth yearly comparison for the establishment survey from January through July for the past 5 years. And as you can see, there was a large distortion, obviously, from the pandemic. It was pretty much expected for 2021 to have a huge snapback from the large decline in employment. But ever since then, it's had a pretty stark decline, right? To the first half of this year, from January to July, only having 597,000 new jobs being added in 2025, compared in 2024 around this time, it was more than double. So can't ignore the deceleration. All right, we beat that dead horse. Now, taking a look at the household survey, you have to realize that they talk about these two different buckets here, right? So you have people who are in the labor force and then people who are not in the labor force. People who are in the labor force are people who have a job, who are employed, and then people who are in the unemployed bucket, which are people who are specifically looking for a job within the past 4 weeks. So these are people who are actively have been looking for a job in the past month. As soon as those people stop saying that they've been looking for a job over the past 4 weeks, they get pushed into the not in the labor force bucket. So it's important, just remember that here for 2 minutes. But the Fed is mostly hung up on the unemployment rate, specifically headline unemployment, which the calculation for that, just a reminder, is the amount of unemployed people, right? So this yellow bucket divided by the labor force, which is the green bucket here. So this divided by this. And so that's how you get the unemployment rate, right? And so right now it's at 4.2%. That was the calculation in July. This isn't something that has been, brand new to what the market has seen. It was the same in May, April, March, November of last year, August of last year. If we take a look back over the past 3 years here, you can see that the first time it got to this number was in July of last year. And so it's pretty much maintained that level and hasn't gone past it. So really the magic number that the Fed has talked about in previous meetings, as well as other Fed chairs, is around 4.5%. So, even though we had the large revision decline and, that kind of shocked the market on Friday, when taking a look at the unemployment rate, which is what the Fed is looking at, they're looking at this and saying, hey, we're still at 4.2%. That's still incredibly low compared to the historical average here, right? This is going back all the way to 1950. Look, right? So, they might just look at the unemployment rate and be like, hey, we're still at significantly lower historical unemployment. There's really no reason to freak out about the revisions until that translates into the unemployment rate. Now, there's a problem with that, though, getting into the other buckets here. One is you're having a decline in the labor force participation rate, right? So the amount of people who are in the labor force, the total population, right? So the population who are 16 years old or older, this bucket is shrinking, and it's moving into the not in the labor force bucket. And so, even though we have a low unemployment rate, that could be because, even though more people are going unemployed, this denominator here is also getting lower as well because people are moving out of the labor force entirely, which is a little bit strange, right? And so you can artificially have a low unemployment rate if the labor force is also shrinking, which is what we're seeing. All right, let me see here where I lost my spot. All right, so taking a look at those buckets as a graph themselves. The employment level going all the way back to May of 2022 has been declining. The unemployment level has been rising a little bit, but it has leveled off since September of 2023 in terms of additions, and it's actually been declining a little bit here. So the unemployed bucket is also declining. And then let's take a look at that not in the labor force bucket, right? So that's this one right here. These are people who either can't work because they have a disability, or they just can't work in general for whatever reason, or they're people who still want a job, but they just haven't been actively looking for the past 4 weeks. But in the past year or so, they have at one point have been looking for a job, and they do want a job. So take a look at this number, right? So pretty much since June of 2024, this has been accelerating, and then since 2025 has began, this has had a huge acceleration. So it's kind of a weird labor market, and it's showing to the tightness of the labor market right now. And so when you take a look at that sub bucket of the not in the labor force camp, people who do want a job, that has risen, but not as much as the people who don't want a job, right? So you can see here that most of the contribution from the acceleration in the not in the labor force bucket is people who just aren't looking for a job and they don't want a job. So it's like, what is actually happening here? And I think it has to do with a lot of people retiring. But the main takeaway is that we're having artificially low unemployment because the total bucket is shrinking. And it's just a very weird situation. And you might think to yourself, oh, well, they're not counting people who are like Uber driving, or, there's been a large boom in people who have been, self-employed, starting their own businesses or whatnot. But when taking a look at the employment level for self-employed people, you can see that that's actually been declining, since it peaked in May of 2024 and is now negative. Same thing with people who might be in S corps, who are paying themselves a salary, who might have a little bit of a bigger, smaller business. That's also been, declining as well. So it's not the gig economy. And so really it points to people who are just either in retirement or not. And what's also interesting is that when you take a look at the population rate, right? So this is the change in thousands of people. So it's the year-over-year change in thousands of people going all the way back to 1960. Look at this huge drop-off in population growth that we've been experiencing since June of 2024. Isn't that quite significant? Maybe it's just a normalization from this huge COVID whipsaw. But still, just zooming in here, we've just had a massive drop in the rate of population. Whoops. Um, and this is the rate, by the way. This isn't like the number of people. If we go just to the nominal number, this is what the nominal number looks like. But when we take a look at the percent of change, we can just do the percentage if we want. That's near 0.6%, where at the peak it was around 1%. So this could just be COVID normalization, but it is interesting seeing that decline there. And then Yardeni Research, they have some good charts here. You can't ignore the huge decline in birth rates. So we're still experiencing, it's like a combination of low birth rates, tight job market, baby boomers retiring, a lot of that capital moving with it. And then, yeah, people just don't want to quit because it's hard to hire right now. And so it's an incredibly tight situation in terms of population in the labor market, all of which are not good, signs long term. Because what happens when you actually start to have stagnant population or even a continued declining population? Well, then, your GDP declines if you don't increase productivity, which is why there's a huge wave of investment into AI and why AI stocks are booming right now because, the government is freaking out about this population situation. That's really, they say that, demographics is destiny. Well, the huge long term problem that the government is facing right now is the collapse in the United States population. The Democrats' answer to solving that problem is just import people, open up the borders. The Republicans, and I'm not choosing a side, I'm just telling you what the different strategies are. The Republicans are no, we need to increase productivity per person by another technological revolution, right? So they're just two different theoretical answers to the real problem that we're dealing with here. And so, what does that mean ultimately? What it means is that inflation could remain higher. I'm sorry, you could see a disinflation happen because it's just productivity is going down. And then, in order to keep GDP up, the government has to keep going into debt, unless you have an actual, increase in productivity or population growth. So that's the big problem here. That is the overarching issue. What's interesting is that I don't know if you guys remember, but the SOM rule, recession indicator, this has to do with the unemployment rate. And if you guys remember, around this time last year, all over the headlines, it was like, oh, the SOM rule just got triggered. We're going to go into a recession. It was above zero point 0.5. Well, that has continued to decline, month over month, essentially. And it had a huge decline again. So this SOM rule recession indicator, which it's not a preventative type of indicator, it's more of like a coincidental slash lagging indicator. This itself has been declining over the past year and it's not signaling recession. So again, this is another indicator that the Fed is looking at and they're like, hey, yeah, that was a pretty nasty revisions that happened, but that's what the Bureau of Labor Statistics. That's not a reflection of the unemployment rate skyrocketing. So again, all this to say is that I don't think it's enough fuel for the Fed to be like, all right, we're automatically going to start cutting rates until they see that unemployment rate start to tick up again. We also got the Fed's preferred inflation gauge, which is core PCE, and that stayed at 2.8% year over year, and it did accelerate if you go back a few decimal places from 2.757 to 2.793. So it was a little bit of an acceleration, but still remains at that 2.8, which is not a decline in inflation there. And in fact, if we go ahead and look at, I didn't have this up, but let me just pull it up here. This is the Cleveland Fed's inflation nowcast. that they produce and update every single day. Highly recommend you keep track of this one. But oh wow, I actually haven't looked at this in a little bit. And they have headline CPI going to 2.9% in August. So they have inflation continuing to go higher, core CPI remaining at 3%, and they have core PCE going to 2.9 from 2.8 2 months in a row after this print that we just got. So the Cleveland Fed has inflation remaining incredibly sticky. So, um, so yeah, I think the Fed is just going to keep focusing on inflation, and I think that the dip that we just saw was a buying opportunity. Um, Now, getting to the last little bit of data. Sorry, this is taking so long, but we just had a lot of data come out last week. The ISM manufacturing PMI, which also came in lower than expected and is remaining in contraction, still showing that growth. There's not really a sign of acceleration there. In fact, the manufacturing sector is contracting at a faster pace in a lot of these different, after looking at all these different components here. So yeah, manufacturing sector, services sector, not looking too hot there. We're going to continue to see GDP growth slow or remain stagnant. And so all that being said, the target rate probabilities for the September Fed meeting is at an 80% chance that they're going to cut by 25 basis points, and then nearly a 20% chance that they remain paused, which is significant because just the day before the jobs report on Thursday, this was at 60% versus I think it was 20%. So I had a 180 flip just based off of that jobs report, but I'm a little bit skeptical of it staying around an 80% chance if we continue to get inflation numbers remaining sticky. We also had earnings reports last week from a lot of the big four in the Mag 7 stocks: Microsoft, Apple, Amazon, Meta, all of which came in positive. So nothing too worrisome in terms of earnings with the big tech companies. We also have a couple here: Palantir, Eli Lilly, AMD, McDonald's, Disney. Some of those names who are reporting this week. Eli Lilly is the big one there, with a $722 billion market cap. That is on August 7th, which is on Thursday in the morning. So not as big on this week, isn't as big in earnings, as well as it's not as big in the macro data. So, but yeah, that's pretty much what we're seeing here. Going back to the charts, one of the big things that I like to look at in terms of gauging to see if the Fed is going to cut rates is this ticker right here. So everybody needs to be tracking this. The ticker for this is IRX.P. This is the 13-week Treasury bill. And the reason why this is important is because it has a pretty good job with pricing in Fed cuts way before they happen. And so when you look at this here, back when the Fed was going to do their 50 basis point rate cut last September, even mid-August, this thing was starting to collapse. Not collapse, but just really price in that 50 basis point cut. And so that actually started in late July too, when this really started to decelerate. And so yeah, before the July 30th meeting, this was already pricing in pretty much a 50 basis point cut. So this is a really good leading indicator of what the Fed is going to do policy-wise. And as you can see, even after that day last week, this is remaining at the same levels. So it didn't have a huge fallout like it did this time last year. So that's another reason for me with the bond market signaling the same thing that I've been it took me a while to discuss there. But essentially, all those thoughts that I just had are summed up in this chart right here. The yield curve. No, that's not it. Oh, yes, it is. The yield curve had a decent jump up on that. Still remains pretty much flat, same levels that it was back in April 10th. The yield curve has been signaling that the Fed is going to, remain at their probabilities of their current Fed funds rate. So the bond market is signaling, pretty much the conclusion that I've been talking about on this video here. But all right, where are we at here in terms of time? I'm a little bit over 5 minutes, but that's okay. Lots of data last week. Oil continues to accelerate. Gold had a little bit of a bump, was selling some into that. Silver remaining in bullish trend. Copper had that huge dump and remains bearish. This is something the team and I are still trying to wrap our heads around. We're not sure why copper had this huge fall off there. I think it might have been around something to do with the Trump tariff on copper, but copper is a big growth signal. Bitcoin had a decent amount of price declines. The large candle being on Friday, and then this week volume has pretty much dropped off, and it's having a little bit of a spike here heading into the day tomorrow. Yeah, and that's pretty much. I think futures just opened up for the S&P, so it's opening up a little bit. So yeah, we'll see. Like I mentioned before, though, the big takeaway is that we still remain bullish on the S&P 500 in terms of our process there. So, but all right, with that, what we're going to do is we're going to go ahead and end the live stream for our people who are joining us on socials, and we're going to go offline just for the people who are on the Zoom call. So if you're on the Zoom call, just stick around while I end the stream, and let's all just say bye to the YouTubes as well as the TikTok and Instagram. Bye, everyone. Good luck out there this week.